Welcome to the EXP Group's Express Notes discussing CIMA Paper P2 Management Performance. The candidate for this paper is recommended to download the Express Notes from the EXP Group's website and to read through the introductory section explaining how the Express Notes are structured and what they're intended to achieve. We want to emphasize that preparation of paper P2 based solely on the Express Notes gives only an overview of the key topics. It's not in itself sufficient to achieve the mastery necessary to pass the paper P2 exam. CIMA Paper P2 takes performance management to a higher level, and there are a series of topics that we will discuss in turn. Let us begin with pricing and product decisions, and specifically in the context of relevant decision-making. Now, this is important. Relevant decision-making allows management to decide how to price products, whether to accept projects, whether to produce something in-house or to buy it outside. In other words, a series of relevant cost-benefit analyses to see whether something should be outsourced or not, whether to shut down or discontinue operations at a division level or a subunit of a business. All of these decisions rely critically on what we call relevant decision making. Now, what is relevance in this context? We're going to look at a couple of examples that illustrate the meaning of relevance. What we're going to be looking to do is to isolate and understand future cash implications of undertaking a project, for example, or the implications of taking a certain managerial decision. Let's just look at these in turn. For example, if a company's trying to determine whether they should continue to transport products by truck or switch to the railroad, then they're going to have to make an analysis of what will change in terms of their costs, actual cash costs in the future. So we're talking about cash, future, and incremental. What we mean by incremental is what are the differences in costs that count if we undertake a decision or do not undertake the decision. This is what we mean by speaking of relevant costs. What are not relevant, it's good to look at a list of those items as well. Some costs are not relevant. Why? Because they are in the past and they're already spent, so they do not affect us going into the future. Committed costs at the same time are also as good as spent, and therefore, if you're in the habit of keeping your promises, committed costs are deemed to be not relevant. So, just to summarize, and this has been covered in paper P1, so this is really a review of existing concepts that the candidate should be familiar with. Relevant costs have to involve cash, they should be incremental, and they relate to the future. And remember, we also include opportunity costs. So for example, if a company were to redeploy a revenue-generating asset to another use, then the fees which are foregone has to be considered an opportunity cost when evaluating the feasibility of switching the assets, in this case a piece of land, to a new use. Another area of decision-making is the accept-reject decisions, and here we have a company that produces fire hydrants at the moment, and they've been asked to consider a contract to supply garden ornaments with the following conditions, and a typical exam question could involve determining whether the company should accept or reject this order to produce garden ornaments given the existing production that they have for fire hydrants. So in each of these cases, we have learning points which emerge from the from an analysis of the scenarios, and this is really the core of the relevant decision making in this part of the syllabus. Costing projects is another standard exercise done by management, and that is to determine what the relevant costs are for the ingredients that are used or employed in producing a product. In this particular case, we have a company which has a proposed contract. They need to use 200 liters of agent Q and 50 kilograms of compound P. We have the certain amounts of the two ingredients in stock already in the company. We have their historical prices at which they were bought at the current market prices and scrap values. We also have some other qualifying data here that agent Q is no longer in use. That's an interesting observation, and the compound P is in regular use at the company. And this makes a difference as well as to what the specific relevant costs are going to be for the two materials that are to be used in the contract. So the learning points which arise from the scenario above and the analysis are summarized here. Similarly, we have make, buy. This is whether to outsource components that are used, in this case, car heaters for inclusion in this company's product, or whether they should produce the car heaters themselves in-house. And here, very significantly, we can observe that the laborers working at full capacity producing carburetors. So there's an existing product, and implied in this scenario is an opportunity cost, which is, of course, relevant from the standpoint of relevant decision making. Opportunity cost is a relevant cost, and therefore has to be taken into account in order to determine whether or not the company should be making car heaters or buying them from outside. And finally, shut down decisions, another category. Here's a car company operating in 3 locations, and we can see that from a financial accounting point of view, the Superior plant is showing a loss, and therefore management is considering closing this down. And the question would be, should they do so or not, and what are the considerations? Looking at the costs and the cost structures, and here's an important clue, 25% of the costs are fixed costs allocated by head office. That smacks of costs which are not relevant, and therefore our decision has to be guided by looking at costs that are relevant in order to make qualitatively good decisions. Each of the cases which are covered or mentioned in this chapter are discussed extensively in the classroom, and conclusions are arrived at through application of the technique of relevant costing by the participants. The dilemma of short-term decisions and fixed costs. Remember that when we are making short-term decisions as to whether to produce something or not, we're looking at the availability of resources in the short term. In the long term, we have to understand and remember that all costs, including fixed costs, are relevant in the sense that they have to be covered. A company which generates contribution is generating the means to be able to cover fixed costs as well. Therefore, the contribution has to be sufficient to cover at least the fixed costs to achieve a break even. And if it doesn't do that, the company is not going to be around very long.